And we're live. Hey folks, my name is Justin. You're on Fast Entrepreneur. Before we start, I just want to show you the setup. So I'm in here driving, and what I did was, if you could see this, I took the tape deck here and I pulled it out a little bit so I could sit my phone right on top of it. So there you go. All right. Anyways, let's get into it. I wanted to just kind of have a candid discussion about probably one of the most important principles that I've ever learned, and that's when it comes to like money or finance, and that's diversification. So let's get started. Nothing I say is financial advice. You always do your own research. We already know that by now. I'll just let me take a step back and tell you who I am. Just when it comes to finance. So when I was younger, I was always kind of interested in numbers and exponential functions and stuff like this. I ended up, doing internships, and I actually got some really good training in investments and life insurance, risk management, yada yada. And I went to Princeton University in New Jersey. I studied economics, and it was there that I learned about diversification. And so I kind of want to just give you my what I learned from that and why. So diversification is basically just a fancy word for saying don't put all your eggs in one basket. But I guess the real question is why, right? Why is diversification potentially a good strategy to follow, and what does it mean? So the whole idea behind diversification, and the easiest way to think about diversification is like an index fund, something that follows like the S&P 500 is an index of 500 companies in the United States, and it tracks basically 75%, give or take, of like the largest companies in the United States. So instead of going out and buying just one or two stocks or one or two of those company shares, you just buy a whole basket. Now the pros of this are, some will go up, some may go down, but you will kind of level. You'll kind of level off your downside risk as well as your upside risk, and so that's you're probably never going to hit, like in the S&P, right? You're probably not going to get, 1,000x gains, by buying the S&P in a year. Maybe one stock may do that, but the others most likely won't. And so you'll level it off. Now, over the long term, right, the S&P, or you could take something like the Dow Jones Industrial Average. The Dow Jones Industrial Average is only 30 companies, and it's kind of more of a historical, index. I think the S&P is a little bit more representative, or something like the Russell 2000, which is actually probably more representative, 2,000, companies. So it starts to include some of the smaller cap companies in the U.S. But why should one diversify? So the whole idea is you're trying to minimize your risk while maximizing your return. And so over the long term, you won't see, hopefully, as much volatility, right? The high ups and the low lows as you would if you just went all in on one single asset. Now there's other ways that you can diversify, right? So we just talked about diversifying, say, amongst companies, say in the United States economy. But what happens if the United States economy, goes up, goes down? How can you diversify? Well, that's where you can diversify and look and diversify around the world. And you can diversify into, indices or index. I'll just say, what's the word? It's not indexes, right? It's indices. But, from multiple countries, so that you're diversified. You're diversifying your risk of one country possibly, having really bad things happen, or let's say, you're minimizing the risk to currency depreciation in any one of those countries, maybe geopolitical issues. potential, fallouts because of war, et cetera, et cetera, et cetera. And so, when people are thinking about building a portfolio, right, you have to really think about what your risk tolerance is, what your time horizon is, right? Like, if you're taking a 30 to 50 year approach, right? I'm just saying this is just, one way to think about it. 30 to 50 year time, then you can afford, some greater volatility perhaps, if you believe that the overall trend will be, going up or appreciating in time. Whereas if you have, say, a 5 or 10 year time horizon, then obviously more volatility could really hurt you if you need money at a specific time period, but the markets have taken a beating. You don't have the time for it to come back. So diversification, huge principle. I learned this, I'd learned it, reading books, when I was younger, but when I was in college, one of our professors, Burton Malkiel, you can look him up. He's written many, bestsellers, namely a book called A Random Walk Down Wall Street. Highly recommended. It's one of those books that, whether or not you know a lot about, stocks, bonds, money, etc., or you're just beginning, it's written in a way that really anybody can pick it up and gain something from it. But A Random Walk Down Wall Street, and basically, he points out in this book how a simple strategy, an index fund strategy over time, that, and he kind of jokes, like, you could literally, he says, you could literally take a bunch of monkeys. Yeah, I'm talking about the right? A bunch of monkeys, give them darts, put a, just a regular, newspaper with all the stock tickers on the wall, cover it up with a towel or blanket, so the monkeys, even if they could read, if they were that smart, they couldn't even see what was underneath them, and then just have them throw darts at it, and whatever, stock tickers that the darts were to hit, say give them 50 darts, and then take all those and throw them in a basket, and that would be your index. He says, over, doing this many times, you can actually outperform the market, with index funds, rather than actively managing, individual investments. And so that's where kind of the whole premise of, active versus passive investment strategies come about. And to take that a step further, Burton Malkiel actually was good friends with John Bogle. John Bogle, if you don't know, John Bogle was the founder of Vanguard Investments, one of the largest companies for, assets under management in the world. We're talking trillions of dollars. And the whole premise of Vanguard is just that, is they provide and sell, index funds, and specifically no-load index funds, many of them, meaning that they don't even charge you, exorbitant fees to be in these. Like, we're talking some of the lowest fees in the industry. And it was all based on, again, that principle of, if monkeys basically could outperform the market, then why wouldn't we just, why would, Wall Street or others, why would they charge you to be involved in, index funds if you could just pick them, set them, and forget them? And that's kind of what Vanguard did. And a lot of people said to John Bogle early on, he said, you're crazy. It's never going to work. Nobody's ever going to do this. That's not how Wall Street works. Well, he had a conviction, and he did it, and he believed that if the people understood what we're talking about right now, that they would change their behaviors. And sure enough, that's what happened. And so, there's a lot more kind of technical, math that goes into how to build an optimized portfolio so that you can minimize your risk, maximize your gain. But I think for most people, unless you're working in that field, for most people, that's probably not, what is needed. I think just looking at the idea of diversification, what it means, how you can apply it to your own life and your own strategy. And so that's that. So yeah, if you want to check out A Random Walk Down Wall Street, I think you really enjoy that book. I recommend it to a bunch of other people. And I've always liked John Bogle. And I say this and I caveat it because, I talk a lot about crypto in this, but you could apply the same thing. Listen, you have to do what makes sense for you, but you may really enjoy crypto. You may want to, have more exposure to crypto you know, depending on your risk tolerance. But, you know, even for regular folks that have never even thought about crypto, you know, maybe they're 100% in, you know, index funds and Vanguard, and that's all they thought about. You know, even like, you know, a 1% diversification into a higher risk asset class like crypto and blockchain potentially could, you know, help that portfolio over the long term, you know, see higher returns with lower risk. And, you know, so, you know, and you think about 1% is not a ton, but think about it. Let's say somebody has $100,000 portfolio, 1% is say $1,000. But if that $1,000 goes to zero, okay, well, now you're down 1%. But if that $1,000, say over time, were to, you know, do a 25x, now that's $25,000. You know, so your portfolio, just around it, your portfolio goes from 100,000 to 125,000, simply because of that 1%, say, in crypto or whatever. So now your crypto portion makes up 20%, right? 25,000 on 125,000 portfolio, 20%. So you can really see how, you know, this is how some people are thinking about diversifying into different asset classes. Crypto's just one of them. But anyways, I hope that video helped you. I'm going to get on with my day, but diversification, name of the game. It hasn't changed. I think it's a, you know, powerful principle to live by. So see you later, folks. Peace.